So today I'm going to talk about a stock I've started buying, and this is the first time I've started buying this stock. I owned it previously, but it's been such a long time since I last bought it. The last time I bought this stock was about 3 years ago. If it wasn't 3 years ago, it was 2 years and something, but that doesn't make a good headline to a video. So I think it was actually around about 3 years ago. Yeah, 3 years ago, I think, since I last started buying this stock. And the reason why I've started buying this stock is because financially the stock has just continued to improve. But when you look at the share price, it's stayed pretty stagnant. And the other week they brought out some earnings, and I looked at the earnings and I thought, wow, these were really good. And then I looked at the future growth plan and what they've got in development and recent acquisition as well, which is quite exciting. And I looked at it all, you look at the previous growth, it's been very good, probably should be higher than where it is right now. And then also you look at the exciting game plan they have going forward. I thought, you know what, I'm going to have to go buy some shares in this. And today I'm going to update you guys about this stock that is, I guess it's kind of like a new stock just because I've not bought for so long. But yeah, I do already own it. But I did do quite an aggressive buy this week already on this position. Before we do get started, just want to say thank you for the support on the YouTube channel. It's been really good. Like it was a year ago that I was making a video on the YouTube saying if things keep up how it's going, I don't know how sustainable like the YouTube channel is going to be, because the views had deteriorated a fair bit, the subscriber base had deteriorated a fair bit, and the last year it's just really picked up, and especially like the last 2 or 3 months it's gone absolutely bonkers. We're on the verge of pushing towards the 20,000 subscriber mark, and already from where we hit the 19,000 subscriber milestone only a couple of weeks ago, we're already on 19,268. So yeah, if you could keep subscribing if you're new around here, that'd be amazing, because if we do get to that 20,000 subscriber mark, that would mean a lot to me, to see that far left number change, and to hit the 20,000 number is a number that I've been aiming for a long time. So if we get there, that'll be absolutely amazing. Anyway, let's go on to today's video, why you clicked on the video. So the stock I've been buying is K-Box. I have started buying again into K-Box. The last time I kind of bought in K-Box, I believe, was in this sort of range during this 2022 time frame. And since then, you know what, the stock has actually performed quite well since those 2022 lows, up 74%. However, for me, I had a bit of an average. I was buying back in like 2020, 2021. The share price went absolutely ballistic, and maybe should have took some profit off the table. And then what happened during this big fall here, you can see the stock lost a lot of value, nearly 57%. Obviously, that 2022 stock market crash happened. We had that inflationary pressure, and also they had the previous CFO. The CFO did some controversial things. Well, there was 2 things really. He messed the accounts up, and that because of that he got given the boot. And there was also some suspicious insider moves that kind of went on during that time frame. So since then, they booted the CFO out, got the new CFO in, and yeah, apart from that dip there, if you do look at when the stock actually IPO'd back in kind of 2018, the stock has stayed nearly stagnant for the last 7 years it's been a public company. And really since only really that dip, most of it has been trading sideways. You go before the CV situation, it's pretty much gone sideways. So yeah, a lot of sideways action for K-Box, even though financially it's absolutely crushed it. And if we just show how good financially it's actually performed over the last few years, if we go before the 2020 situation, this was a company that was making 18 million in revenue, and now it's currently making 42 million in revenue. And if we look at where they were in 2020, before the CV situation, they were making about 3 million in profit, and now they're currently making 4.3 million profit. So financially, all the numbers have moved very much up in the right direction. Yet when we look at the share price, for example, when we go before the 2020 situation, yeah, there's been not really much movement on the share price, and in my opinion, yeah, it's back at very attractive levels. Now, you guys on the Patreon, you guys know that I have talked about this recently on the Patreon. I did an exclusive video on the Patreon, and I went through their earnings on a bit of a review around about 3 days ago, and I said time for some exclusive content on Patreon, and we take a look at K-Box earnings after a very solid earnings update. And I went on that video and I said, look, you know what, these are so good. I ran the numbers and I went, I'm buying, I'm increasing my position. Now, funny enough, when K-Box did bring out their earnings, which was on the 15th of July, the initial reaction on K-Box's earnings was the stock actually stayed stagnant. Like the earnings came out and the stock just didn't move off the earnings. And that's when I went, you know what, I'm going to have to buy some shares in this. because the stock hasn't moved, and these numbers are amazing. But actually, since I've called out like these earnings were really good, the funny thing is the stock has actually started rolling up a little bit. So since then, the stock is actually up 12%. So hey, I say before, it pays to pay on the Patreon because you get the live updates with what's going on, and obviously you'd have got that a little bit earlier. That I thought this was a bit of an opportunity. But even though the stock has rallied up 12%, I still think this is still got plenty of upside, and I'll actually show you the numbers in a little bit of how much upside I believe that is currently going on with Catebox. So Catebox, I'm sure you've seen one of their stores somewhere. So these are one of the stores. In there they've got like smaller cakes you can take away, or you'd go get a big birthday cake. The birthday cakes are an item that a lot of people still aren't cutting back on. People like to go out and spend on a birthday cake when it's someone's birthday. And as well as that, they have some miniature stalls sometimes in some locations, which I think is an area that they have a lot of potential to go tap into a bit more that they're currently not tapping into. So with these cake boxes, there's only a few of them. Well, I say a few of them. I think about 250 of them right now. A lot of them are done through franchisee models as well, and there's big room for expansion in them as they continue expanding. If we look at the recent financials as they've just closed, so group revenue increased 13%, total franchise sales were up 9.5%, like-for-like sales was up 3%, so really strong like-for-like growth there. 26 new stores, gross profit grew 12%, underlying EBITDA was up 17%, and as well they increased the dividend by 11.5%. So with this stock here, you're currently getting around about a 5% dividend yield. Now last week you could have picked this up for a 5.5% dividend yield, and also the dividend increase on top. So it was actually around about a 6% yield on Catebox last week, which is incredible. So this is, even right now though, even at a 5%, actually when you factor in the new dividend yield, it's actually about 5.5% right now. So with this stock right now, what you're getting is in my opinion, a dividend stock, but you're also getting a value stock, because when you look at the forward PE, it's definitely in the value range. It says 18 times earnings now, but when you start looking at the forward numbers, because it's grown so quick, on a forward PE, it's actually a really attractive level. And obviously it's a growth stock, because when you are growing at 13% year over year, that's obviously comes under the territory of a growth stock. So it's very rare you're able to pick up a company that ticks all boxes. It appeals to dividend investors, it appeals to value investors, it appeals to growth investors. It's a triple threat stock. Very rare you find these, and that's one big reason why I do like the company. Like-for-like sales, a lot of people like looking at like-for-like sales when you're a retail company, and you can see here they came in at 3%, which is obviously really strong growth. Now if you actually look at H2 for 2025 actually came in at 6.7%. Now if any of you guys go and listen to the webcast that they did, they said that this has also continued into the H1. So 6% like-for-like sales is actually very, very good if they're able to maintain this as they carry on growing. Now what is also key is online sales. So online sales has become a bigger part of the business and been growing at a really good rate. So one of my criticisms of Catebox back in 2022, 2023 is that online sales were poor and that the website was poor. Lot of space to maximize that. What they did about a year ago is they brought a new website out. So much better. Don't know if any of you guys have tried the website. Obviously, if you're doing a bit more research into the company before you invest into it, try the website. It's a lot better now. So one of the things that I see people say is like, oh, well, actually, when you go past a lot of the stores, they're actually not that busy. Well, probably because a lot of the sales are coming from online now. When you go into one of these stores, it's not like Tesco's. You're not walking around doing your grocery shopping and staying in there for half an hour. You're in and you're out. You do your birthday cake order, you go in, you pick it up, you're away. You're in there, 60 seconds? So a lot of the online sales are growing rapidly at the moment. You can see here they're currently growing at 23%. Now, they've actually said that this has continued to accelerate, and that's actually gone into 25% as well, into this year as well, which obviously fantastic if that continues at those sort of rates, which is great. They also said their customer base is growing. So one thing that they did, and this is also one of the criticisms that I had of Catebox back during this time frame, is that they didn't maximize a membership as much. And they have started adding a membership now. So with the membership, you sign up to the membership, and you can see here the growth in the membership has grown quite well. Now, I think there's a reward, every time you order something, if you order it so many times, you get a free reward or whatever it is. But the thing is that you're on the database then, and they can send you offers, it's somebody's birthday, get an offer through, you know what? It's so-and-so's birthday, good reminder, I'll go get it. And what they're able to do is also, if they can tie up the ability of like, oh, we've noticed that you had an account and last year you bought a birthday cake around this time for someone's birthday. Is it their birthday again? Do you want us to get a cake sorted for you? Just click this, buy, cake sorted. So it gets people getting into a bit more of a repeat cycle, which, if you have that kind of repeat cycle that people get, it says five birthdays in your family every year and you are buying 5 cakes every year. It's a bit of a retail SaaS model that they're building up there, which is absolutely great. New products, they're always bringing out new products. It amazed me how they always kind of find like the next upcoming thing with likes of Ferrero UK, Nutella. What's the other one that people are going mad at the moment? Is it Dubai chocolate or whatever it is? Always adding in that kind of new trend into some of these cakes that they're currently doing. They've started, and I'm actually quite surprised that they haven't done it a little bit more often already, but they started doing more product ranges around events, festival ranges, or Christmas time. I got to say that Frankenstein cake there. If that's happening this year, I'm going to buy that one for Halloween because that looks pretty cool, which obviously great to see. And overall, I just took a screenshot of the financials again. You can look at how much of these numbers are moving up, really in the right direction, when you look at the group revenue point of view. And that's with a lot of investments as well inside the businesses, and also being a tough year for them because, retail stocks, they're being hit by extra tax, they're being hit by the NI increases, the wage increases, cost of making acquisition. They've been opening up a new factory in Bradford for expansion as well. So considering all these investments that they made and the things that they've had to deal with, you can see, look at these numbers here, and they're absolutely amazing. Now, the other really good thing about this company is they've also made an acquisition into Ambala, a leading manufacturer and retailer of Asian sweets in the UK since 1965. They currently have 19 stores, and at the moment they are planning, I think they said on the webcast, to open 10 of these every year. Now, that could be a major growth driver for them, and obviously what they could do as well is they could sell it into the cake box stores in some locations, and then the other ability they have is to open up another store on Ambala in some other locations if it's just a pure store with that there. And this is going to be an interesting move for them because they paid 22 million for this business, and Cake Box has been a really good winner for them as they've had these stores and they've done really well for them. But this is another area now that they're moving into, and we know that Cake Box is a pretty highly profitable company, and with this acquisition now, it opens up the door because if they can replicate what they've done with Cake Box and do it with Ambala, which when you look at the history of Ambala and how successful it's been, you'd think that Cake Box are the guys to do it. And what sometimes happens is, when you're investing, we always talk so amazing about share buybacks. We talk so positively about dividends. But do you know what the number one thing is that companies can do to really improve you as a shareholder? Make a good acquisition. If you make a good acquisition, that is so much better than dividends and share buybacks. Because if you make a successful investment or an acquisition, and that acquisition continues to grow for many years, the profit grows for many years. If let's say that you buy a company for 10 million, and when you bought it, it made 1 million profit. And in 10 years' time, you're making 8-9 million of profit. You nearly 1 year alone is making the profit back from the acquisition. And then with all that capital, you can go throw that back into share buybacks or dividends. So that can actually pay for itself and make even more, than what you actually paid for it. Not to compare like Ambala to YouTube, but look at like Google and YouTube. Look at Facebook and Instagram. I know there's a big kind of jumps from there from a store location with 19 stores, but you get my point. Like these can be the really big game changers for them. If Cake Box now turn around and they get Ambala to, let's say, 60 locations in the next 5 years, that's going to pay for itself by far. Now, they have taken a little bit of debt on to make this acquisition, which is probably worth pointing out. They used to have a really good balance sheet. They still have a pretty good balance sheet, to be fair. They're sitting around about 56% debt to equity, but they have taken a bit of debt on, around 15 million. But Cake Box has said themselves, like, one of the priorities is to pay down this debt very quickly, which, great decision. If they can make this work and pay down the debt, that's absolutely fine. And it's not going to be much of an issue for them because, it's 15 million in debt, but when you look at how much profit they generate every year, 4 million a year, it's not going to take too long. And with as well the synergies and this new acquisition, if you look at the forecast on the profitability now as a scale up and the new factories that are coming in as well, we're expected the net profit to go from 4 million to 6 million to 7 million. If they do hit the 2027 guide, we're only getting towards a yearish away now. 7 million, they're going to pay that debt down within 2 years, which is 100% worth taking this acquisition. So I'm excited for where that does go going forward. So we'll see what happens there. And with Cakebox themselves, they've currently got 251 stores, and their end game is at the moment to get about to 400 stores in the UK. So if they're able to get to 400 stores in the UK, which I think is achievable, still plenty of room for them to expand, especially up north. And there's not many of the cake boxes up north and into the likes of Ireland, for example. I think they only opened up the first one in Scotland like a year ago. So there's certainly big expansion room for them. So I think they can get to 400 locations, and then obviously Ambala on top. And then they're also trying France. They've actually launched a pilot into France, and if that's successful, that could be another major growth driver for them. And obviously the ability to maybe even move into somewhere like Australia, New Zealand, it should transition quite well over there. So yeah, they're still, I'm on international expansion there, but even without the international expansion, there's still a major growth driver for them in the UK. And overall, when you look at the growth, like how they've historically delivered, really good growth. And with this acquisition on top, you're going to see a really good bump up in the revenue, and historically growing about 10% a year when we go natural without the acquisition jump here. And as well, when we look at profitability, we're expected 6 million in 2026, 7.5 million in 2027. And if you look at 2027's numbers, which I'm starting to do with these guys, because obviously we're about a year and a half away now from that, so we're not that far away. And if you're a long-term investor like me, you're looking 2 to 5 years down the line. So that's not even like into like the big horizon where we're normally looking. A year and a half is actually quite a relatively short time. And if they do hit this guidance of a year and a half's time, growing about 10% a year and profit of about 7 million, and you're paying about 11 times earnings for it. And for me, when I look at that, I'm let's not forget last week before the when we had the share price jump that we've had in the last week, you could have actually be picking up Cakebox, and you're picking up at 10 times forward earnings. With the growth that they have, the valuation here, and obviously you got that lovely dividend on top. Yeah, I was a big fan of it. So I've actively started buying Cakebox for the first time for a while. And just to kind of show you some numbers here about what the potential of Cakebox could be. So I put an 88 million market cap in. I've put 4.68% revenue growth in, which is historically a lot slower than what they've grown at. I put a 10, 11, 12% profit margin in, which is historically a lot lower than what they've previously been doing. Obviously, they've been making a lot of investments. So if we look previously, they've actually been, you can see here, 21% profit margin, 17% profit margin, 18, 16, 18% profit margin. And you can see here they've been making a few investments, and that's why the profit margin has gone down. So if they have the ability to get back to the old like 17, 18% profit margin, I've not even factored that in. I've kind of kept them about where they're currently at right now, to be fair. So I'm not being too crazy on the profit margin either. 20 times earnings, I think for a company growing 10% a year, paying a 5.5% dividend yield, growing at these rates, yeah, I think it should be the market average valuation of 20 times earnings. So on the low side, even on the low side, we're getting 62% on the upside, which is straight away like 60% with only 4% revenue growth and profit margins not expanding. Yeah, I like that. And obviously you factor your dividend on top, say 5% over 5 years, 25% return, but I think that dividend will get hiked up. But same again, I'm not factoring that in. You're up to like 85% return on the low side, which is, yeah. Mid side 92%, on the high side 126%, but obviously throw your dividend on top, 150% on the high side. Yeah, this is well in the range of where I was like, yeah, I'm happy to buy. And don't forget, a week ago, those returns were even higher. I mean, if Cakebox was to really smash it, and let's say like they do continue growing at like 10% a year, let's say they do drag the profit margins back up to like a 15% profit margin, you're up to 204%, and dividend on top 225%. I mean, let's say like the market goes really crazy and goes, oh my days, like this is so exciting, let's put you up to a 25 times earnings, like Greg's were at its peak growing at 10% a year, you're up to 280%. Now, like I said, I don't like assuming like big frothy valuations and big metric expansion, But what I'm trying to say here is, like, if this company was to really execute to perfection with double-digit growth and profit margin expansion and multiple expansion, for a company selling cakes, it's not a bad return. That you could see up to a 300% a 3x return. That would be absolutely amazing. But obviously, that's 10 out of 10. The perfect storm happens. Even if we don't assume the perfect storm, which is what I like to do, I don't like to get too crazy with what's kind of going on out there. What I invest for. I invest for 2 to 5 years, and I aim to get 100% return over those 2 to 5 years of holding the stock. And yeah, this is ticking the boxes. This could generally be one of those stocks that does come in the 100% return, even on the worst case scenario. And certainly if it does quite well, it'll be a nice return. But if it does an absolute amazing performance, then that's absolutely exciting. But yeah, I like Kate Box. Like I said, for me, it's a triple threat stock. It's not often you have the ability to go buy a stock that ticks the list where it's a value play. 11 times earnings for a year and a half's numbers. That's a value investor would be all over it. If you're a dividend investor, a company that pays a pretty good dividend, 5% a year, does it have the ability to hike up the dividend going forward? 100%. We've just seen in the last financials they've just hiked it up another 11.5%. So if you're a dividend investor, you're like, yep, it's a nice yield. They're growing. They can afford to hike up that dividend. They've got a history of hiking up pretty good rates. So dividend investors are going to be interested in it. And if you're a growth investor, you look at this Ambala situation and the acquisition they made, and historically they've been growing at good rates, and you're like, yeah, it's got growth. It's growing double digits every year. So yeah, it's great. It's really, really good. So yeah, I'm a big fan. I've actually started buying back into the position for the first time for a good 2-3 years, and we'll see what happens. But yeah, it didn't make me laugh. That's the market for you. Like, I can't believe, like, when they brought their earnings out, the share price just stayed stagnant. It didn't move off the earnings, even though they were really good. And then now the market goes, actually, they were really good, and now the stock's gone up 14% since they brought their earnings out. But hey, it shows you sometimes, like, the market can be quite slow sometimes to react to the numbers and realise actually we probably should go up on this. What I will add in actually quickly, but I was going to say, I'm going to come to the end of the video there, but I'll add in something here. I know a lot of you guys use Trading 212. I'd say like I'd probably guess that like 80% of you guys use Trading 212 as your investment broker. Kate Box is a horrible stock for Trading 212. They seem to put the order. They seem very slow to execute orders, and I think the current limit on Kate Box for shares you can own is something like 350 shares or something like that. So for some of you guys, including me, if you are buying Kate Box on Trading 212, it's not great. So yeah, I'll just let you know, like, when I'm buying Kate Box, I'm not buying. For me, I personally don't buy Kate Box on Trading 212. I buy it through another investing platform, because yeah, it's an absolute nightmare for liquidity. And with Trading 212, they limit the shares to like 350 shares or something like that. So the max you can own is like, I don't know what, 600, 700 quid or something. So yeah, if you are going over that, or if you will go over that in the next, when you do your initial buy, or if you plan to add into the position, you just be aware there's nothing worse that you start adding up into a position and then you go, hold on, I can't buy any more because Trading 212 won't let me. So just be aware of that as well. I'll give that little shout out there. Just be aware of that situation. Anyway, that's it. Hope you enjoyed it. Have a great evening, and I'll see you tomorrow.